All right, this is Nick here for Merk Research, and about to go through some highlights from the updated chart book on the business cycle. So why is the business cycle important for investors? This chart shows the S&P 500 in log scale going back to the late 1920s, and the U.S. recessions here are in the blue bands. And what you can see visually is that oftentimes the S&P 500 is falling during recessions. I went through the numbers, and historically the S&P 500 returns have in fact been considerably worse on average during recessions compared to expansions. So the numbers over the past 90 years, going back covering the calendar years from 1928 through 2017, the average S&P 500 monthly return during expansion months was plus 0.89% per month. That was for a total of 889 months of expansion, or 82% of the time. And that compares to an average S&P 500 monthly return during recessions of negative 0.71% per month. That was over 191 months of recession, 18% of the time. So let me say that these are just averages, and there are some notable exceptions. You can see here in 1987, there was a sharp drop in the S&P 500 without a recession. And then conversely, in the mid-1940s, the S&P continued higher through the recession of 1945. Also, it's important to note that these recessions are not it's not known the month that they start. So the NBER, the National Bureau of Economic Research, they're the official timekeepers for these recessions. And for example, if you look at this recession from the early 2000s, it started in March of 2000, but it wasn't actually announced until November of 2000. So you don't know in real time when these recessions start. But that's in large part the point of this analysis, is to try to understand in real time when the economy has likely entered recession. All right, so with that, let's go through the charts. Here we have the leading economic indicators index year-over-year rate of change. The latest reading came in at plus 5.7. That was up from the prior reading of plus 5.5. So the LEIs are continuing to accelerate higher here. This is the year-over-year rate of change that we're looking at on the chart. So that's a positive sign for the economy in the near term, roughly over the next 6 months or so. And in terms of my characterization of this chart, obviously I'm still positive. To reiterate, what would get me negative is to see this year-over-year rate of change fall to 0 or negative. All right, moving on to the yield curve. So this is the yield curve steepness represented by the 10-year U.S. Treasury yield minus the 3-year U.S. Treasury yield. The yield curve is actually steepened so far year to date. You can see this uptick here. I just keep this chart on a monthly basis, but this little uptick here is showing basically from the end of last year to the current update, which is through February 2nd. So that's actually steepened from the end of the year plus 43 basis points to currently plus 52 basis points. This kind of steepening is known as a bear steepening, and what's happening is that both the short end and long end rates are moving higher, but long end rates are moving higher faster than short end rates. So I think we're still in a multi-year flattening trend. And my base case scenario is that this is going to go negative or inverted before the next recession, which has happened looking at the past here, going back to the early 60s. In my view, the fact that we've had this little bit of steepening is in the fashion that we've had it, which is that the long end rates are rising faster than the short end rates, and that both are rising, is a positive sign for the business cycle. A bull steepener would be a different story. That's a situation where the short-term rates and the long-term rates are both falling, but short-term rates are falling faster than long-term rates, and the curve steepens that way. And that's what you tend to see after inversion is that the Fed starts to cut rates, and the short end rates are falling faster than the long end rates. And so that's what was happening here in 07, 08, 09. And that's typically what you see happening. You see a steepening in these recessions, but that's a very different type of steepening than this little bit of steepening that we're seeing here. All right, so yeah, currently my characterization remains positive on this. As I said, I would expect this to eventually go inverted before the next recession. So what would get me negative is to see this yield curve steepness fall to the 0.00 level or below. All right, here we have the manufacturing and services PMIs for the U.S. So the latest manufacturing PMI reading came in at 59.1. That was down from the prior reading of 59.7, which was revised lower to 59.3. Nevertheless, the reading is still well above 50, so generally still positive on this picture. To reiterate, what would get me negative is to see this manufacturing PMI black line fall to the 50 level or below. Here are the global manufacturing PMIs. This basically captures the 12 largest economies in the world, and it's important to put the U.S. expansion into a global context. Right now, this is a highly synchronized global growth picture at the moment. However, we did have several downticks from the last readings. So 8 out of 12 of these manufacturing PMIs ticked down. Those were Brazil, India, China, the US, Germany, the UK, France, Australia. Those all ticked down. 4 out of the 12 ticked up. Those were Japan, Russia, Italy, and Canada. Okay, but all still above the 50 level, and generally I'm still positive on this picture. What would get me negative is to see any of the US, China, Germany, or Japan, or India go below the 50 level. All right, let's look at the momentum of the labor market. So we just had an update on the US jobs report. I'm slightly less positive on this picture this month compared to last month, but generally still positive on it overall. The latest jobs report had the U3 unemployment rate unchanged at 4.1%, and the labor force participation rate was unchanged as well. This is the 10-month moving average here in blue of the labor force participation rate. So maybe a little bit of slowing in the momentum of the labor market. You can see the gap is closing a little bit between the U3 rate and its 12-month moving average, which is the gray line, and possibly a little bit of a dip on this 10-month moving average of the labor force participation rate. To reiterate, what would get me negative here is to see this U3 rate cross above its 12-month moving average. So in other words, see this black line cross above the gray line here, while this labor force participation rate is trending lower. Currently, we're not there yet, but a little bit less positive on this picture relative to last month. All right, here we have my recreation of the San Francisco Fed U3 leading indicator model. So this black line here is the U3 unemployment rate. That's the official reading. We just got the update of 4.1. And this gray line here is the model, which is basically designed to be a leading indicator for what's happening with the U3 rate. And you can see that it's acted that way in the past. It's kind of led these turns in the labor market cycle. So this is continuing to trend lower, which is a positive sign. I wouldn't be surprised to see this official unemployment reading drop below the 4% level sometime this year. Generally still positive on this picture. What would get me negative is to see this U3 model line trend higher on a year-over-year basis. As you can see, this indicator can be somewhat early, and it's a little bit volatile in the past, and so any analysis of this should be put in the context of other indicators. All right, now this is the Atlanta Fed GDP Now forecast. This is currently suggesting that the Q1 GDP growth rate is on track for 5.4%. That's the highest it's been since this series was created, which is in 2013. That will almost certainly decline, in my view, into the end of this quarter. You can see that it can be very jumpy and then often decline declines after these big rises. But it does suggest that we might be getting into a higher growth gear in the U.S., which some analysts have speculated about given the fiscal stimulus from tax legislation. Also, the first official reading for Q4 2017, that came in at 2.6%, and that was lower than the expectation, which was around 3.0%. Now, this is only the first reading. It'll get revised twice before it's final. Then the year-over-year reading, we've got the first indication of that. So for the full calendar year of 2017, that is the current data suggests that the GDP grew 2.5% for 2017, and that suggests that growth has been accelerating since the middle of 2016, and we may see that trend continue. So this picture looks positive to me. What would get me negative is to see this Atlanta Fed GDP reading basically down in these low, kind of sub 1% or below 0%. All right, then this chart here shows basically consumer confidence, provides a sense of the overall health and optimism of the U.S. consumer. So the University of Michigan consumer sentiment is in gray, the Conference Board consumer confidence index is in black. And these tend to be trending lower going into recessions. Right now, this chart, to me, shows a little bit of a mixed picture. On the one hand, consumer sentiment and confidence are high, at generally high levels, but they might be at risk of rolling over. This University of Michigan consumer sentiment index is trending sort of sideways to down. The Conference Board consumer confidence index is trending sideways to higher. So it's a mixed picture. What would get me negative is to see both of these indexes trending lower on a year-over-year basis. All right, so we covered the LEIs, the yield curve, the U.S. PMIs, the global growth picture, the labor market, GDP, and consumer confidence. Overall, the picture still looks very positive to me, and as a base case scenario, I do expect the expansion to continue over the next 3 to 6 months, and in general until further notice. The LEIs and the recent yield curve steepening are improvements in this picture compared to last month. The global growth backdrop shown by the global manufacturing PMIs, that picture is softened somewhat, so that's something to keep an eye on. The momentum of improvement in the labor market looks like it's slowed a little bit in these past readings compared to last month, but the leading U3 model suggests that the unemployment rate should continue to decline for the time being. And as I said, I wouldn't be surprised to see the U3 unemployment rate below 4% at some point this year. U.S. GDP growth looks like it's continuing to accelerate higher. And in terms of the U.S. consumer, I'm looking forward to getting the New York Fed Household Debt and Credit Survey, which should be out later in the month of February. That'll give a little bit of a better idea as to whether the consumer credit cycle might be turning. The narrative there is basically the opposite. The narrative is that the consumer is going to be very happy this year with their paychecks reflecting the tax changes and any salary increases from year end. And that may well be the case. As I said, overall, I'm positive on the near-term outlook, but my goal is to be objectively driven by the incoming data and to follow my process. The idea is to keep my eyes open to what's going on and hopefully to serve as a cross-check to your own thinking. Going forward, I'll plan to put out an update on the S&P 500 shortly and then put out the next business cycle presentation in early March. This week, we're putting this video out on our new Patreon homepage. If you find this content valuable, please consider becoming a patron. Also, many of you have requested a written version of this analysis, so we have a PDF version of the slides and analysis posted on the Patreon page as well.